Hello, advanced financial planning students. We're now in week 2. I just want to say I really enjoyed reading the forum discussion post from week 1. Great interaction with everyone, so continue that up for week 2. I went ahead and put out a forum discussion for week 2. It asked you kind of how do you track your financial statements? What system do you use? Do you use a system at all, or what are you thinking about potentially using? So that will be open up starting today and through the rest of the week. So again, just remember to get in there by Thursday, make your initial post, and then respond to 2 of your peers. This week we're going to look at chapters 4, 5, 6, and 7, so you have a little bit of reading to do. Start off with chapter 4. It's going to look at some of what I call the rock stars of finance. You hear names such as Modigliani and Markowitz. Talk about different theories, and it's really about, tying a little bit about how a business and a household can be very similar. Businesses have balance sheets, they have cash flow statements, they have income statements. Their goal from a business is try to maximize the business value. From you as an individual, you're really trying to maximize your standard of living, and we do that through the choices we make. And I liked how the textbook mentioned, that the idea is that in theory you should die broke, so you should be using all this money throughout your lifetime, have it balanced and not having these big up and downs throughout your life. But again, we have choices in life. We have the choice to work, we have the choice to consume, and we have the choice for leisure. And ultimately we should try to make the best choices in asking those questions. Is this really going to make me happy for the long run? And that ties to a variety of different things, not only things that we buy, but the choices we make in life too. So with that, you're going to read a little bit about the theories in that chapter. Markowitz talks a little bit, relative to portfolio return, that we don't want to look at individual investments. We need to look at it at portfolio investments. Also, the more risk that we're willing to take on, the greater the return that should be. It doesn't mean it's a guaranteed return. And that by diversifying the assets that we have, we can reduce some of that risk. So now after chapter 4, we get more into the applications. You start to look at chapter 5. Gets more specifics about the balance sheet. All of you should at least have a net worth statement that you should be tracking to see how you're doing over a period of time. But also have a statement about cash flows. And if you notice, they said the functional statement of cash flows is really the better measure to have, where you're looking relative to operating, financing, capital. And then again, taking this into later chapters, is doing pro forma statements, that you should be planning out for maybe the next 5 years, because as we go forward in life, cash flows change too. There's going to be different demands, different needs. Like I think I mentioned in my first week 1, I have a son that will be in college in 4 or 5 years, so I have to anticipate that I may have additional expenses in that time period. Hopefully I've been saving enough, but it may also allow me to look at these future cash flow statements and say, I'm not saving enough, maybe perhaps I need to save more if I want him to go to a certain type of school. And then you're also going to look at, towards the end there with chapter 7, the idea of what I like to call operating leverage and financial leverage. Operating leverage, more from a business standpoint, and probably from an individual standpoint, personal financial standpoint, can be the risk of just things that happen in life. What if you were to lose a job? What if your spouse was to lose a job? Or what if the economy doesn't do as well? Financial risk ties more into the amount of debt that you take on. How leveraged are you? And as again in the first week I said, not all debt is bad debt. You're going to school is good debt if you take out student loans. You're buying a house, you're buying a car. But if you're pushing the limits that you're so leveraged, and if something bad does happen, that can make your credit costs go way up. It can make choices of life more difficult. So it's finding that right balance. And the textbook talks about, financial ratios too. What is our debt relative to our income? What is our debt overall? So it's not a bad thing to have debt, in my opinion. It's just how we use that debt. And the last part of this section of readings ties in more, what is the cost of that debt? So you'll get into more calculations specifically, figure out interest and payments and those things. So anyway, I want to say thoroughly enjoyed the first week with you guys. I'm going to plan to do this, post a video every Sunday. Just keep it brief, give you an overview from the week. But again, this week we'll have the forum discussion, another homework. Use the key to check your answers, but do send me an email or post something online if you do have any questions. Have a great week, and we'll talk to you online.